The NFP preview, as promised, as aforementioned, non-farm payrolls, the king of forex indicators, of course, politics, Trump indicators a bit, but it's still important. So a bit of background for this report. This is the first jobs report of 2017. It's the jobs report for January. Obama was the president during most of this time. I think it's mostly related to Obama. Also, the next report, it's the starting point for Trump. It's when the presidents moved on. So job gains in recent months were quite steady. So it was around 150,000 jobs gained, 170. These kind of numbers. Wages remain the focus. Why? Because if the U.S. economy is nearing full employment, we should, if we have employers competing for employees on jobs, the wages, the salaries are expected to rise, right? So we did see that indeed in December. In the report for December, published in early January, we had wages rise by 2.9% year over year, the highest level since 2009. But in the past, we've seen wages, as well as other figures, go 2 steps forward, 1 step backwards. So let's see if this is consistent. Last time, we had 156,000 jobs gained, basically in line with all the previous figures. So this time, we're expecting more of the same on the headline jobs report. 170,000, very, very similar to the expectations last time and to the result last time. And wages are the focus. 0.3 month over month is what we're expecting. Last time it was 0.4 month over month. I would watch out for the year over year figure because it's a wider measure, less volatile and more reflective of trends. The unemployment rate, very important politically, but less for market movements because the unemployment rate always depends on the participation rate. It's expected to remain unchanged at 4.7. If we have the unemployment rate not move, but the participation rate rise, of course, it's good news because we have the same level of unemployment with more people in the workforce. And another measure to watch is what's called the real unemployment rate or underemployment, U6. It fell, I think, to 9.3 last time. Still much higher than the official unemployment rate, but moving in the right direction. It's on the right track. So underemployment rate reflects also people who are too discouraged to look for a job or who are working part-time when they actually want to work full-time. Sorry for this noise. Okay. The reaction we're expecting is for the US dollar. What's going on with the US dollar in recent days? It's under pressure, trumped by Trump. In general, wages are more important. If the headline is between 130 to 210,000, that's quite a wide range. I know it should not matter too much. We'll leave the stage for wages, okay? So in this case, if we see the round number of 3% year over year on wages, or of course higher, it's good for the dollar regardless of anything else. If wages fall back significantly from the 2.9 level seen last month to 2.6 or even lower, it's bad for the dollar regardless. What happens if everything falls into line, if we do not have any surprises? In that case, I would expect the US dollar to slide. I would expect the US dollar to be on the back foot, especially against the safe haven yen, okay, because of Donald Trump, and the euro, which has natural demand. Remember, when nothing happens, the positive trade balance of the eurozone, thanks to German exports, supports the strength of the common currency, okay? The US dollar does look good against the pound. It is contingent, of course, on what the Bank of England does tomorrow, but the pound, in comparison to its peers, is one of the weaker links. The US dollar, however, is weaker against the safe haven yen, the euro, and I would also add commodity currencies, at least for now. This could change against commodity currencies because when we have a risk-off sentiment, commodity currencies weaken. But for now, we had good news from basically all three countries, Canada, Australia, and New Zealand, especially Canada. So commodity currencies have reasons of their own to rise. Okay, so if nothing happens, the US dollar is on the back foot, and the non-farm payrolls, and of course, wages are key. Strong wages, good for the US dollar. Weak wages, bad for the US dollar. Okay, so that's our NFP preview.